Welcome to Investing Insights. I'm your host, Ivana Hampton. A pair of game-changing decisions is clearing the way for a surge of crypto and other ETFs to hit the market. The Securities and Exchange Commission recently agreed to fast-track the launch of crypto ETFs. The timeline will shift from a long case-by-case review to standard listing approval. Another SEC ruling is giving the fund industry a reason to cheer. Dimensional fund advisors can now add an ETF share class to its mutual funds. Many of its 70-plus rivals are also waiting in line to get the green light next. What should investors know to prepare for the arrival of these new crypto ETFs and ETF share classes? Joining me is Brian Armour, the Director of ETF and Passive Strategies Research for North America at Morningstar Research Services. Thanks for being here, Brian.
Thanks for having me.
What was your reaction to the SEC removing these regulatory hurdles?
Yeah, so I think there's a couple different aspects to it, but in general, it's very consistent with the messaging from the new administration in reducing some of the regulatory burdens and articulating a more clear framework, which I think was needed. So no surprise based on what they'd been messaging prior to this.
Let's start with the SEC rule change that affects crypto ETFs. Can you explain the new investment choices that could be available and what would they track?
Yeah, so the changing is basically setting generic listing standards, which the SEC approved. The exchanges, I think it was ARCA, NASDAQ, CBOE exchange rule changes that would allow them to do this. And it basically says, if you meet this criteria, you're allowed to list an ETF. So having that streamlines the process, and what we're expecting is new cryptocurrencies that aren't currently available in an ETF will then be accessible once they meet those standards and file. And so it'll be a shorter process. The SEC won't have to go through one by one and approve each filing. It's similar to what we saw with like the ETF rule in 2019, where prior to 2019, every single new ETF, even S&P 500 ETF, whatever, had to be individually approved by the SEC. And so it will open up doors to new cryptocurrencies, but that's really where we're going to see the product development as we start off with Solana and something like Dogecoin just launched, XRP, some of the bigger names, and then we'll continue down the list. And there's something like Avalanche and Bonk ETFs that are currently in filing.
How soon could we see these new crypto ETFs?
They're already starting. Existing filings are already starting to list under the new standards. And then going forward, the new ETFs would have to meet the standards and then file. And then I would expect a couple months after that, they'd be ready to go on an ETF.
There are already spot crypto ETFs trading. Could the introduction of new crypto ETFs push down fees overall?
It's possible. I would almost argue the opposite, because I don't think we're going to see a lot of Bitcoin and Ethereum ETFs launch in response to the new standards. So the difference is now when there's a clear standard, the approval process will be more like one by one as filings come in and they come out, come to market. The reason why the fees were so low to begin with for Bitcoin and Ethereum ETFs was because SEC basically had these large batches of approvals where they'd just say, okay, these 11 Bitcoin ETFs, today you're all approved, you can all list tomorrow. And that created just such an intense competition in the filing process where they were cutting fees and undercutting each other on fees throughout the process leading up to that approval. We won't get that going forward. So with some of the more esoteric cryptocurrencies, there might be the potential to charge higher fees.
How have crypto ETFs performed so far in 2025?
Yeah, so there are many different types of strategies, but for spot Bitcoin and Ethereum ETFs, spot Bitcoin's up about 30% on the year. Spot Ethereum's up 34% this year.
And we'll just timestamp it that today's Wednesday, October 8th. So what crypto ETFs do Morningstar consider solid choices for investors?
Yeah, so these spot crypto ETFs, they hold the underlying assets. There's not that much different between the different options. And so it's really in the eye of the beholder of what cryptocurrency is interesting to them and what they might want in their portfolio. Once you know which cryptocurrency you want, we look at it as like we would gold ETFs or any other, direct asset ETF, where there's a total cost of ownership. You have to consider fees. If you're a long-term investor, that should weigh more heavily in your decision. And then you also have to think about trading costs. So what's the cost to cross the bid-ask spread when you go to execute your order? And so typically, iShares have been the most popular versions of these strategies. So IBIT for Bitcoin, ETHA for Ethereum. And those will be the lowest trading costs, but there might be ones with lower fees.
Now, Morningstar considers crypto to be speculative or a high risk asset. Will you remind investors who are listening and watching why that is?
Yeah, well, Bitcoin doesn't actually kick off, and Ethereum and cryptocurrencies, and mostly in general, they don't really kick off any income or any sort of. They're not an income producing asset. So in general, you're really just betting on someone paying a higher price than you in the future, and that's why we call it a speculative asset. And gold is the same way. It's largely speculative in terms of its investor base. So, with that, as sentiment changes or as cash needs change, you can see large swings in performance. So, if you look at 2022, for example, Ethereum was down almost 80%, Bitcoin, I think, over 70%. So, there are risks. There are obviously, moments of, significant risk for investors and volatility, but that volatility is also on the upside. It's had some great upswings as well.
Let's switch to the SEC's other rule change. It has approved dimensional fund advisors to add an ETF share class to its mutual funds. Can you explain what an ETF share class is and provide a brief history lesson on it?
Yeah. So there's a mutual fund can have multiple share classes. Um, in general, an ETF tracking the same strategy would be a separate fund. What an ETF share class would do is it would just bring it into that same fund so that all the holdings, all the operations, the fees would all fall within the same fund structure for both the mutual fund and the ETF. And historically, that was only really allowed for Vanguard. They were the only firm that was approved. They actually had a patent that expired a few years ago. And they only had it for passive funds. So for active funds, this has never existed. Dimensional, only an active manager. They don't have many passive funds. And so this is an opportunity for active managers to add ETFs to their mutual funds for the first time since Vanguard was approved about 20 years ago. And what happened was all these different asset managers had filed about after the patent had expired in 2023. And so it's been 2 years in the works to get this approved.
And speaking of that, all these groups have filed. 'Cause more than 70 asset managers have banded together to get permission from the SEC to offer dual share class funds. How often does that happen, Brian, and why in this case?
Yeah, it's unique to get that sort of common advocacy across the industry. But yeah, I actually follow Ben Johnson on Twitter for this. He's my go-to source. I think we're at 81 filings as of today or yesterday. But anyway, so yeah, it's rare to see so many different firms on the same side. I think in this case, the opposite side are maybe like platforms. They don't want to have to build the infrastructure to be able to list these things. And so I think what the main goal here, the reason why asset managers are so interested in it is because then they can meet investors where they are, whether an investor wants a mutual fund or ETF. They can be agnostic to the structure and give both options.
What do individual investors stand to gain from these new ETF share classes?
Yeah, so there's two main things. Number one, tax efficiency to the mutual fund share classes. ETFs are more tax efficient. They can, when money comes in, they can, or money goes out of the fund, they can exchange for securities in kind rather than buying and selling the securities themselves. and that allows them to not realize capital gains. They can also use the ETF structure to get rid of some of their higher capital gain securities and make the fund more tax efficient generally. So when you add an ETF, that can make the whole rest of the mutual fund more tax efficient as well. The other part of this is that mutual fund holders that maybe they've held the mutual fund for 40 years, which was the case for someone that reached out to me when the ETF share class was approved. This person said they have held this mutual fund for 40 years. They were wondering, will this mutual fund have an ETF share class? Because they've wanted to be an ETF forever, but they're sitting on these huge unrealized capital gains, so they can't sell without a huge tax liability. So if the ETF share class is approved, we're expecting exchange privilege, which is basically like all existing mutual fund shareholders then have the opportunity to move into the ETF without realizing any taxable gains.
So a lot of anticipation is building.
Yeah, definitely.
So let's flip it. What could investors lose?
So they could, in some ways, it's like a light version of the ETF, a standalone ETF share class. It probably won't be as tax efficient. The benefits for ETF investors may not be as strong as for the mutual fund investors in the deal. There are things like if the mutual fund has to manage some flows themselves, then they might need some cash on hand to deal with some of those redemptions. It won't be to the same extent as a standalone mutual fund, but now all of a sudden ETF has to deal with a little bit of cash drag. And there can be some fees like the exchange. How does the mutual fund investors pay for the exchange listing fee for the ETF? And these are small on the edges of like the overall performance, but small concessions.
So what is the takeaway for investors as this new wave of crypto ETFs and ETF share classes arrive?
Well, there's going to be a lot more ETFs, which we have not been short of.
Not at all.
But yeah, I mean, basically you need to look at the underlying strategy. The ETF is just the vehicle. That's all it is. So underlying cryptocurrency, or does this ETF share class make sense? Because really you're buying the strategy at the end of the day, and that's going to be the most important thing.
Well, Brian, thank you for coming to the table and letting us know the wave of ETFs that are coming.
Yes,
you're going to be busy.
Lots more to come. Yes.
Let's dive into a few market headlines with Dan Kemp. He's the Chief Research and Investment Officer at Morningstar Investment Management Europe. And Dan writes the weekly Markets Brief column on Morningstar.com. And I'm excited to share that he's back in our Chicago studio to help us separate the signals from the noise. It's a pleasure to sit across from you, Dan.
Hi, Vanna. It's great to see you.
Welcome back. So last week on Investing Insights, we talked about how a U.S. government shutdown would stop the release of economic data like the monthly jobs report. How could a shortage of data affect the Federal Reserve and others who depend on this information?
Yeah, that's a great question. And so Jobs Friday just became Friday. And that left all these economists and market commentators with nothing to talk about. But it was a really interesting experiment from an investor's perspective because it allows us to think about how we would behave given different outcomes to those job numbers. So we know that people tend to respond to those numbers. But from an investor's perspective, we need to take a step back and realize that you shouldn't always respond to those numbers. There's a weak link between short-term economic data and investment returns. So it was quite nice, actually, not to have that potential distraction, those potential temptations to react to the latest piece of data. So I think it's a really interesting time for investors to observe how they normally behave and maybe improve that behavior going forward. So there are some small upsides sides to the shutdown. From the Federal Reserve perspective, now that is an independently funded agency. So they'll carry on releasing their data. It's just the more directly funded government departments that won't be releasing their data. So the Federal Reserve today, we're recording this on Wednesday, they'll be releasing their minutes from their last meeting. So we expect those to be released as normal. But it's the more closely linked agencies to the government, the federal government, that won't be releasing their data.
Well, let's talk about this week's Markets Brief column, because you brought up something very interesting. You wrote that the stock market may be on the verge of a so-called melt up. Can you explain what that is and why cycles like this can be dangerous for investors?
It's so dangerous. It is the most dangerous time in markets. We are entering a really tough period potentially for investors. And a melt up is where investors interpret all news as being good news. What we see in markets in those periods is just day by day, they seem to keep going up. And so if you've taken a more skeptical view, particularly if valuation's already quite high, then you're continually tempted to change that view and buy in at even higher prices to try and chase the market higher. And if that carries on, you can end up being overcommitted at very high valuations, what some people would call the top of the market. We never know where the top of the market's going to be in advance, but it can be a very dangerous time because people who are trying to be thoughtful, trying to invest when prices are lower and not overcommit when prices are high, tend to have their confidence undermined. And so I just wanted to flag that might be a period that we go into. It doesn't always happen, but it's normally at the end of a long cycle that you have these short-term periods where prices just keep climbing and it feels like the world has changed.
What are you tracking for next week's Markets Brief column?
Yes, absolutely. So as we go into next week, a couple of things are happening. So we've crossed over into a new quarter, as everyone will know. And so that means that we've got earnings season coming up. And this is going to be a really interesting earnings season because analysts seem far more optimistic than they normally are coming into this earnings season. We won't have many results next week, but we'll just be starting to prepare for that news flow coming through when hopefully people will be moving from thinking about the economy to thinking about individual companies, what's going on in real company experiences. And so we'll be a little bit focused on that, but also the whole idea of forecasting. We're getting into the end of the year. We're going to be deluged with forecasts for 2026. And so just thinking about how investors should think about those forecasts, how they can use those forecasts, and again, what's dangerous for investors when they're trying to make decisions.
Well, everyone listening, watching, if you want to read that, and you do want to read that, go to Morningstar.com on Monday to read Dan's great insights in this Markets Brief column. Dan, thank you for coming to the table all the way from London.
Well, it's great to be here. Thanks for having me on.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you, and subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to Senior Video Producer Jake Van Kersen and Associate Multimedia Editor Jessica Bevel. I'm Ivana Hampton, Lead Multimedia Editor at Morningstar. Take care.